Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with our podcast, my guest and I will do a weekly podcast on all things real estate, from interest rates to the economy to what's happening in Washington, the Federal Reserve. Anything that can affect you and your real estate decisions will be covered here. Obviously, I was on vacation and sick. I lost my voice for a couple of days, so I've got about 2 weeks' worth of material to cram into today's show. Lots of stuff to talk about. Obviously, the Zillow Trulia merger that's set to take place. We want to definitely dive into that and talk about the potential implications on the real estate market, what this means for the future of real estate. I've had actually tons of questions since we didn't do a podcast over the last week and a half about what our views on that would be. So we definitely will talk about that today. We'll also talk about the Federal Reserve and some of the comments they released. Obviously, they continue to taper, left to keep interest rate unchanged. Stock market has been plummeting. Mortgage interest rates got worse. We finally actually had the overall markets reacting to the information that was put out there the way that they were supposed to. An anomaly to the market at this point because we haven't seen much of that lately. So we'll jump into the Fed. We'll also talk about, the surprise GDP number. And, we also have a credit tip at the end of the show. We'll talk about secured credit cards and the annual fees and why it's important to pay attention to your statements because that can affect your ability to be able to qualify for a loan. Joining me on our panel, as he does each and every week, is Louis Camerosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's often cited in the media as a real estate industry expert in the Wall Street Journal, Forbes, Fox Business, U.S. News, Wall Street Journal, MSN, and numerous others. Louis, how you doing today?
I'm doing grand, Ryan. How are you?
Oh, it's good. It's good to be back. Good that I can actually.
Good to hear you.
Yeah, it is. I mean, I had the weirdest bug. Like I was telling you before we came on, my kids had this and passing around. I just physically lost my voice, and I wasn't even talking. It was the strangest thing. But I guess sometimes it is a good rest for those of us that do radio and podcasts, right? So while I was away on my hiatus between being sick and vacation, we've had numerous things happen in the markets, obviously with the Federal Reserve. And I think I want to start, we'll kind of jump into the breaking news and the economic data that's been put forth over the last 2 weeks. One of the biggest things, obviously, that I want to highlight was the GDP that was the second quarter. Obviously, this number will be revised twice, which came in at a reading of 4.0 versus the estimated of 3.0, which for mortgages and interest rates, this was very negative. Mortgage interest rates went up substantially on this news. Now, you and I kind of talked after we had that negative first quarter, right? And that also that negative first quarter was revised to be not as negative as they originally put out there. Now, all of a sudden, we flipped from a negative to, a 4%. I can't make any rational sense of this, that we could potentially have GDP with these type of numbers based upon all the other data that's put out there, which is kind of what we talk about, how they can make these numbers whatever they want them to be. But at the end of the day, you have the second quarter GDP going up, but then all of a sudden it's like, okay, well, now jobless claims come in at 302,000 versus 301. So there's always the positive and negative, data that will offset each other. And this is going to continue to be the common theme. Not to mention that the unemployment rate has ticked up to what I believe it was 6.2 versus 6.1. We've got a lot of these things taking place. We've got construction spending that missed. New sales were 406,000 versus estimated at 479,000. That was a huge miss. The prior reading, which had broken 500,000, was revised back to 442,000. We've got, existing home sales that are coming in lower than expected. None of this overall data is really positive. Now, I want to get your take on how we get a 4% GDP number, knowing that for the last 2 months, Louis, we talked about basically how bad everything's been. How, and granted, we had a longer winter and they blamed everything on the weather there, but I just can't extrapolate enough good things from overall, like, not just, like I said, I always talk about the eye and the ear test, for what's going on the street. But I really feel like this is just a number that's just been thrown out there. I really don't think that there's anything there to support it. What's your take on the GDP number and some of the other economic indicators that have come out over the last 2 weeks?
No, first you have to start with the concept that the jobs recovery, the housing recovery, the economic recovery is nothing more than a 5-year media event. And once you accept that, the Fed prints money 24/7 for 6 years, keeps interest rates near zero, and the media chants recovery, recovery, recovery. So you get used to thinking that, well, of course, the GDP can go to 4%. We're in a recovery. They told us that was just the weather. So, of course, it's 4% recovery. There's this constant, incessant recovery mantra, Ryan, that we hear in every piece of data, good or bad. It all has to do with the recovery. Now, how do you get the GDP at 4%? Well, that's not that too hard to extrapolate. It doesn't mean it's good. It means that you have increased consumer spending. They include things like electricity cost, increased healthcare cost in your GDP. So they've gone up. And then the main reason the GDP went up officially on paper is replenishment of inventories, which, of course, they didn't have low inventory purchases in the first quarter because of the weather. They just didn't have them because they didn't expect economic activity to warrant it. So they increased them in the second quarter. Now, you average that out, that's not a weather issue, inventory, over the 2 quarters, and you got something near 1% GDP growth. So they're not going to replenish those inventories in the third quarter at the same rate. But then, of course, when the third quarter GDP comes in, it's not as good as the fourth quarter. They could talk about unexpected, but we still had this second quarter GDP growth. There'll be something else going on, and they'll return to recovery, recovery, recovery. The recovery is not happening as quickly as expected. Recovery. That's all you're going to hear. I don't know why people aren't sick of hearing that. It's been 6 years of recovery. It's been 6 years of zero interest rate, and now the latest game they're playing is calling everything solid. I think they're trying to switch the narrative from recovery because the jobs report was considered solid. The initial jobless claims was an indication that the job market was solidifying. That's the latest thing. Now, again, both of those numbers, Ryan, the initial jobless claims we mentioned week in and week out means absolutely nothing. 300,000, 320,000, 200, whatever it is, means that, okay, if fewer people are losing their jobs, that's because the labor market is smaller, fewer people are left to fire, so that numbers go down. It doesn't mean more people get hired. But then the initial jobless, the non-farm payroll comes out, it's over 200,000, and people in the media start with the recovery story all over again, calling it solid. Now they're saying it's 6 months in a row. We've had over 200,000, indicative of the strength of the recovery, solid recovery, solid recovery. They keep saying that. And you look behind the numbers there again, and this is the most telling. We talk about part-time jobs fueling the recovery. Last month's big number, 288,000, we saw was a net number based on losing about 500,000 plus full-time jobs and gaining 800,000 plus part-time jobs. This one has another curious fact in it, that the age group, I think it's between 24, 26, and 54, actually lost jobs. And the areas where jobs were gained were in the close to senior citizen, the 55 and older, and, of course, the 18 to 24. Well, what does that mean? 18 to 24, Ryan, that's summer jobs, okay? Yep. That's no big deal. And it's not a good sign to have the prime working year people, 26 to 54, lose jobs, but then senior citizens picking up jobs because they have to, because they get zero interest on their retirement savings. They're either forced back into the labor market or they have to stay working. So there's jobs there. And I suspect a lot of those jobs, they're competing with millennials for entry-level jobs in grocery stores, Home Depot, and so on. Because if you visit any of those stores, what do you see there?
Yeah.
You see older people working there, which you never used to see 20, 30 years ago. That was all younger people working their first job, their summer job that turned into a part-time job while they were going to school, and then perhaps a full-time job for a couple of years. Now you see, 50, 60% of your employees in most of your big box stores and supermarkets are elderly workers. And that's just a sign of a strengthening economy. You can add them to the labor force, and you can add them to the numbers of non-farm payroll and say, tremendous, it was a solid report. But that's what you hear from the media. They don't change that narrative. They talk about 6 months in a row. They talk about recovery. And here's one. U.S. jobless claims rise, but recovery expectations are undaunted. By whom? All that matters is just saying recovery after each piece of economic data, whether it's good or bad. Breaking solid U.S. hiring stretches into 6 months as employers add 209,000 jobs.
Right.
Everything is solid, recovery. It's really pathetic, Ryan, because nothing here. And then the last issue on the GDP is if spending is increasing because of inflation, and they use a deflator which doesn't reflect reality, the Fed now has, Ryan, its 2% target rate, just like it has its 6.5% unemployment rate. And those are the rates where supposedly you have these wonderful numbers that the economy is fully recovered and you can start ratcheting up rates. Well, they don't do that. They're not going to ratchet up rates for 6-8 months after they stop this money printing. Well, that means that the economy really isn't good. They've got their inflation, but we haven't seen the growth that you're supposed to get from this magical 2% inflation. All we see are government numbers telling us that the CPI is well over 2%.
Yep.
But we don't see wage growth, we don't see hiring growth, and we don't see general economic activity. And what we see is food prices soaring since September 2013. Fruit is up 7%, pork 9%, beef 10%, eggs 13%, seafood 5%. Average hourly wages up 1.4, less than 2%. So what you have, Ryan, in all of this is the makings of stagflation. You've got high food costs, high gas costs, increasing healthcare costs, increasing housing costs. Okay, you got a high stock market, but you don't have higher wages and you don't have more jobs. So you have stagflation, and the Fed is going around patting themselves on the back, and the media's complicit with this, yelling solid recovery.
Right. Yeah. Costs are going up. People are getting paid the same, if not less than they were before, and somehow we have a solid recovery. Right?
Right.
Interestingly enough, one of the key statements that was put out by the Fed on their explanation of, the employment is that a range of labor market indicators suggests that there remains significant underutilization of labor resources. Right? Because that's the only thing that they can throw out there. They can't admit that, employment basically just sucks. Nobody's hiring. There are a bunch of part-time workers out there. We're in big trouble, right? By the
way, they tell you there is no inflation, too.
Oh, you know what they said? I'll give you their
inflation pressures are muted.
Well, inflation has moved somewhat closer to the committee's longer-run objective. Longer-term inflation expectations have remained stable. The likelihood of inflation running persistently below 2% has diminished somewhat. There's the somewhat, right?
Yeah.
Mortgage-backed securities are not going to have a major reversal, obviously, because of the long sell-off that happened when the Fed came out and said this. I'm thinking, everything is very carefully worded, right? And so what we have...
By the Fed much more than the media. The media is in full cheerlead mode.
And absolutely, because see, what happens is when they start talking about inflation, now they're saying, okay, that it's coming closer to their objective. That actually means that, hey, they're acknowledging that it's rising, right? Well, for interest rates and for mortgage-backed securities, inflation is the arch enemy of those.
Right.
So what we saw was a major sell-off in mortgage-backed securities last week because of this statement. Now, after the statement would come out and then we had we lost.
Hold on, Brian. By the way, do you really need the Fed to acknowledge what everybody already knows and sees? But I guess you do.
You do, right? And I think that
that's what's sad. You have to wait for the Fed to acknowledge something everyone's seen for a year.
But we've both said, Lewis, that this is a Fed-based economy, right?
You've said that many times.
Right. Everything happens because of what the Fed does, says, what they breathe, what they think. I mean, this is how we move. I mean, in the stock market and Wall Street traders and hedge funds, they move in lockstep with the Fed. So and for us to see that correction in the stock market last week, well, guess what? It actually makes sense because what the Fed said. they're talking about inflation rising. So guess what? Now everybody's thinking, oh, well, it looks like the Fed's acknowledged that there is inflation and they're hitting their target. So what does this mean for the overall economy? Does this mean that people are having to pay more for their food, energy, and other things? Well, that means they might not have as much to buy my products that I'm invested in this stock or this stock. You know what I mean? So naturally, we were seeing a pullback. Now, what are the headlines reading basically on CNN Money and all the other sites? Is a correction near? Wall Street's on edge. Investors are twitchy after losses. This week, they'll be watching corporate earnings. Now, my question to you is, Louis, where are corporate earnings going to come in this week? Are they going to be not as bad as the last quarter? I mean, GDP comes in at 4%. I'm expecting for corporate earnings to be better, but still in the negative. What are your thoughts?
Okay, so corporate earnings are, for want of a better word, a farce.
Yep. Because
corporate earnings are high and you have good earnings per share, that doesn't mean the company's doing well. We know for a fact that the largest reason for corporate earnings increases have been companies buying back their own shares, either borrowing money or digging into their corporate cash reserves to buy back their own shares, to reduce the number of shares outstanding so that the earnings per share look high. That's one reason. Second reason, as you pointed out 2 or 3 weeks ago, the report, and by the way, there was a report that showed that on the S&P companies themselves are the largest purchasers of shares. So it's not like a broad-based reality. Everyone's saying, wow, I got to get these shares. They're high. Second point is the one you raised a couple of weeks ago on a report that sovereign nation funds are probably the second largest purchasers of shares, and they have a vested interest in keeping the stock market up. So you have countries buying shares just to boost the stock market.
Right.
Third reason is because companies have engaged in the last 3, 4, 5 years in significant cost cutting. When you cut costs, your costs go down, your profits go higher. Cost cutting, what does that mean? Firing workers. It doesn't mean increasing your expenses, which is investing in employees, investing in capital equipment because you think the demand is going to increase, so you want to invest in your company to prepare for that. They're not doing any of that. And the last one is the mergers. You merge, you eliminate even more employees. Supposedly the synergies between the two companies produce an even higher profit per share. But nothing in that dynamic, Ryan, indicates that there's increased sales, increased investment in companies. What you have is the investment is in the shares themselves, not in the company's equipment or R&D or employees. It's just in their shares. And the earnings are relatively good the last few years, but the sales are not. The sales are in the low single digits, but the earnings are much higher. So you can keep that up for a while, and they this month or this the quarter's earnings season that come out this month will be okay. They can't see the thing is you cannot blow those earnings out of the water through what we just talked about by buying back your own shares. You can only tweak them up a little higher, and there's a limit to how much you can do with that.
Right.
The only way you're going to get explosive earnings growth, it has to coincide with explosive sales growth. And there are no conditions for sales growth, Ryan, because the consumer is strapped. You could talk about consumer spending went up 1% or whatever, it goes up a little bit. They don't have the money to spend.
Right.
So the earnings will be okay, but they'll tout them as, if they go up or half of them went up or 60% of them went up, they'll say, see, the recovery's still on track. It's not a recovery. It's the manipulations that they're using to give the appearance of recovery that are still working.
Yeah,
and that's what you'll see in the second quarter.
And and you brought up a good point with the spending. And the spending that is taking place, I would imagine, for the everyday average American is debt-based spending, right?
Mm-hmm.
Where
the
people
limit to
are
that, too.
Leveraging their credit cards. So, I mean, it would be interesting if we see the breakdown of, like cash transactions versus credit transactions, because I'd be willing to bet that it would probably be like 75% of the transactions are taking place on my credit cards, or other types of loans that have been given out there, and they're not cash. I mean, when people go on vacation, how many people do you think are paying with cash? Louis. I mean, they're not.
You mean out of savings? They could use their credit card, but are they putting it on the credit card because they know they're going to pay it back the second they get home from their vacation?
Absolutely not. I don't think so at all. And once again, this goes back to the eye test that I use all the time, and I'm not hearing from people that, that they're in a great financial position where they've got money in savings for their vacation, for their emergency funds. They've got credit cards for those things, right? And when things happen, they got to throw them on their credit cards and worry about how to pay for it later. They're not worried.
Yeah, where do you get your news from, though, Ryan? The people you get your news from and listening to the Fed, they don't have a problem making ends meet. They have good jobs. They work at the banks. They will work at J.P. Morgan or Goldman Sachs when they're finished working in their government jobs. They have solid, steady jobs. As far as they're concerned, they're doing well. Everybody knows is doing well. And then you look in the mainstream media. If you got one of those jobs as a reporter, either a journalist or, the few jobs that are left doing that, you're doing fine too.
Right.
And all your friends are doing fine. So you just look at everyone else and say, "What? Why are you such a downer? Why are you such a gloom and doom kind of person?" Because they don't talk to other people.
Yeah. Well, it's not. We're not talking doom and gloom for the sake of talking, just to talk it. There has to be some sort of checks and balances, and unfortunately, as you suggest, mainstream media never does that. They only talk. It's one side of the same stuff out of their mouth all the time.
You want their advertisers? If their advertisers don't want them talking that, because then they'll say, "Oh, you can't afford our products." You're driving home that point.
Yeah, I mean, it's
that they advertise.
Good point. It's solid. It's always solid numbers, recovery, solid recovery, solid recovery. Guess what? You brainwash people when you say that enough, so everybody starts to buy into it. And the Fed has done the same thing. The Fed continues to tout, that we're on the road to where we want to be. And that's
what a failure! They printed $4 trillion, and they don't expect any negative consequences. They think everything's going to be fine. That's a farce. But for them to even think with a straight face to come out to the world and say, "Well, it didn't work," that's the biggest disaster on the face of the planet.
Well, and also what they do is too, they'll tout it as a success because now they're pulling back and they're tapering all of what they put forth to begin with, and so it's like, look, we got all that out there. Now we're pulling it back. We've got everything under control. Things are moving in the right direction. We got the inflation target. We've got the unemployment. We're in the range that we want. Everything is happening just like we had planned, right?
And if it didn't, Ryan, then their credibility would be shot. If they were saying, as we pull back, there's significant risk that we made a mistake, that the economy will do well because we're not printing money anymore. Right. How are we ever going to unwind this $4 trillion balance sheet? They'll never say that. They never self-question or doubt what everybody else is thinking, and nor does the media. The media talks about how the Fed is on track. They did the right thing. They saved us from disaster and so on.
And the only people that they really saved were the big banks, the hedge funds, big money. I mean, who are
that drives the economy, Ryan?
I know. I mean, it's unbelievable that people just don't step back for a second and think, how did the Fed actually help me? Because they didn't. You know what they did? They did help create a low interest rate environment that nobody was really able to capitalize on. I mean, right now, we talked about this the last time. If we just look at how housing and everything to do with housing has now become back page news or no news at all, right? It doesn't make any rational sense that we can have interest rates still in the 4% levels and adjustable rate mortgages that are lower than that, in the low 3s, and that we're not having housing as front page news.
It's worse, having a year-over-year decline from last year in sales of new homes, pending homes, and existing home sales.
Well, how about our boy, Mr. Schiller, right? And the Case-Shiller Index. He basically is turned into a bear on housing. Okay, this never happens for him, by the way. And the Case-Shiller Home Price Index came out, I think it was last week, with 9.3 versus the estimated of 10%. Weaker than expected, and it's below 10% for the first time in a very, very long time. How is this possible in a solid economy? How is this possible in a recovering economy? How is this possible with interest rates at 4%? Well, how is it possible? Because the people that are out there don't have stable jobs. They don't have money in savings for down payment. They don't have good credit. None of these. So for anybody to think that our economy is moving in the right direction, you're probably sadly mistaken. Unfortunately, I hope and wish that these things were taking place, but that the reality is they're not. And no matter what the media tells you, they can spin these numbers. We can have GDP at 10%.
Unemployment at 2%.
Unemployment at 2%, and it's all a farce. Because it's whatever, they're living in the Wizard of Oz, okay? They make up stuff as they go along. The Fed can spin their language of their statements to meet whatever goals they have to set up. And most of the time, it's only to benefit the banks and the hedge funds
Brian,
and the politicians.
the Wizard of Oz, they should just write the headline because.
Mm-hmm.
That's the reason, the wonderful things that they do, that the economy's going up. But Ryan, remember we talked about the two pillars of the economic recovery that the Fed was touting, which was rising home prices. This is Yellen's words, Bernanke's words, that they were boosting the stock market. They made no qualms about that. Housing prices go up. Yellen said something to the effect that it's not just for rich people. When housing prices go up, stock prices go up, people spend more money. That's the Keynesian approach. Stimulate demand through artificial means, and everything will be fine. Well, the two pillars, one of them is shot. Housing is gone. The Fed realizes it. They're not touting that, but they're still saying recovery solid and so on. The only thing they got left, Ryan, is the stock market. And what's really indicative, and this could perhaps act as our segue into this Zillow Trulia merger, is the only real money made in real estate nowadays is in the stock market. Yep. You've got Zillow and Trulia. They've been at it for 10 years. Neither company has made a profit. Yet, they went public. Since they've gone public, their stock prices have increased fourfold, fivefold, tenfold, whatever it is. They have not price earnings. They have price sales ratios in far into the double digits. They haven't made any money since they've been in existence. They lose a lot of money. They join together. Their stock prices go up. This is indicative. That's the top of the market when you see that. This is the Time Warner. This is the Time Warner AOL merger of our time. The two companies that make no money already have gone up significantly. The prospects of making money are dim. If the housing market isn't, has anybody even noticed? If the housing market isn't doing better, I don't care if house prices continue to go up. How are they going to make any money if real estate agents are their prime way to make money, and real estate agents aren't making that money because the volume isn't there? But 60, 80 million people, these are the numbers they throw out. 53 million for Trulia, 80 million for Zillow. Visit these websites. I can't believe those numbers because there's only 160, 170 million adults in the United States. Now, does that mean half of them visit these sites? If they do, they're not buying houses because you know how many homes are sold each year.
Correct. Yeah. Well,
I don't see where these companies are going to do any better now that they're merged because they haven't made money yet.
And what was there? And once again, when you're not making money, you just try to take over another company and then try to put the pieces together, thinking you're going to increase your revenue and still not make any money, right?
Well, they'll increase revenue. There's a limit to how much revenue they can make. The one thing that they can show is that since they've started, is they've increased revenue. I have a little experience in this because I ran one of these real estate portals. You can increase your revenue simply by increasing your sales and marketing. You call up more real estate agents, and you sell more. But guess what? The amount of money it costs you to call up more real estate agents often exceeds what you get back from them. Right. But when you have $120 million in IPO money, and you need to show a $5 million increase in sales, well, you go out and you spend $6 million, and you get your $5 million increase in sales, and Wall Street applauds. They want $7 million next quarter, you spend $9 million to get it. They don't care. They don't look behind the numbers because Wall Street promotes these stocks because they get IPO fees. So they're not going to say, well, there's a troubling thing here. They spend more money in sales and marketing than they get in revenue, and it seems to have been that way for the last 5 years. They're not going to mention that.
Well, yeah.
And in order for them to continue to grow their sales, they're going to have to continue to spend more in sales and marketing.
Right. So both Zillow and Trulia have increased their sales and marketing expense to 80% of all expenses, which is up from 40% a few years ago, right? And that is mathematically unsustainable. It's just you can't sustain that. And the reason why they're having to do that is just like you suggested. They have to spend that money in order to bring more revenue in, right?
Right. That's not a good model, Ryan.
It's not. If that was the model, if that was the founding principles that you and I are starting a company and we're going to spend 80% of all of our expenses there.
No, we're going to start at 40 and we're going to make sure we get to 80 in 5 years.
Right. I mean, it's insane. There's so many of you guys know. Obviously, I have a real estate team, and we do some internet leads. One of the sites that we use is Commissions Inc. I don't know if you've heard of them, Lewis, but the president of the company for Commissions Inc. is Dwayne Legate. He's a very, very smart guy. He really does follow trends and stuff. So he put out over the weekend or after this merger came out just some thoughts, and I kind of want to go over some of these with you. But he brought up some very interesting points because everybody's thinking that, okay, this Trulia Zillow merger, is there a play here where they're basically trying to take over potential MLSs where they become the go-to source? Because they do have the traffic, right?
Correct.
Traffic is great, but it doesn't lead to actual closed transactions, which I think is the biggest component here. Right. You've got let's say for sale by owners, right? We've got all these for sale by owner sites. Fizbo.com, owner.com, there's Yahoo, and all these other different ones. But he brings up a great point that since 1996, the year the internet took off, the number of Fizbos that have been sold has declined by 33%.
Right.
So he said that about 6 months ago, he put a rental property that he had on Zillow. So he was actually listing it for sale, slightly below market value. And since April, he had over 600 people view the property, but not one single inquiry. Not one. Okay? Now,
but Zillow gets to tout how many page views, how many visits came to that site.
Right. And he says, remember, the points that we had made were there's 80 million visitors per month and only 400,000 homes sold in the U.S. So Zillow makes up a fraction of the sold numbers. But it basically is scaring the crap out of everybody, but it really shouldn't. His point is that your casual looker, your casual person is going to go on to these sites to look up their value of their home. But this isn't what's actually going to get a home sold. You know what? They turn around and they're going to go to all the real estate agents out there and say, hey, look, we've got 80 million visitors. You need to advertise on our site because we're getting the traffic of people that want to buy. But in reality, that's not what's taking place. These people are going, they might find a house on Zillow. They're still going to likely turn and go to another site or go to a local professional after they found that property. And I can attest to this. You know how many times, Louis, I get sent a link from Zillow or Trulia or Realtor.com after I've told the client 100 times, do not search on those sites because, number one, they are not real time, right? But they can't help.
Well, actually, Realtor might be because they have the agreement with the National Association of Realtors, so their listings will be fresher.
It still takes, though, at least 12 to 24 hours.
Well, that's true. By the time they load them up, that's true.
Right, you know what I mean? And that's why I said MLS is the only thing that's real-time accurate as far as when it changes instantaneous. If you have somebody on an auto search set up direct from the MLS, that you'll get the right information. The reason why I bring that point up is because sometimes on Zillow and Trulia, the stuff's lagging 3 or 4 days behind, so I'll always get listings sent that were active 3 or 4 days ago that are now under contract, right?
Oh, and they'll leave them on there also because for search engine optimization, you benefit the more content you have on the site. So what? They're a few days old. They've already been sold. You leave them up there, people look at them.
Right. And so we've got people that are listing homes on Zillow now, and I think Zillow actually, one of their goals that they mentioned is that they actually want to bring real estate commissions down. Now, why would they want to do that? Because they want to be the source to be able to sell homes. They want to probably get a fee for having this traffic and potentially selling homes. But as this is shown, it's not very reliable for you to list your home on there to try to save commissions and be able to get inquiries. It's essentially a Fizbo model, right?
The only way I think you can make money on the online space is, if you just sell quality leads, but then your volume won't be that high because most people don't go online looking just to find a real estate agent. But if you have that, you can make money, but that Wall Street's not interested in that. Selling software works, but again, you have to have a real estate agent who's got the money to invest in a software system. But you can make a lot of money doing that. I say a lot. You can make millions, but you can't make this $8 billion market cap. Or you have to be the site that you go to that actually is a real estate site and makes commission from the sales. That would require Trulia or Zillow to become real estate brokers. That's a whole different expertise. That's not about traffic. That's not about innovation. That's about understanding the real estate business and how to get homes listed, sold, how to get buyers.
And more than likely, that would require them to probably buy another real estate brokerage versus becoming one. And then there'd be also...
And Realty bought Zip Realty for that reason, because Zip Realty is a kind of mini Trulia and Zillow, except that they actually sell real estate. And I haven't looked at their numbers recently, but, a real estate business that collects commission and sells software, I think, has a far better shot than somebody that's just selling eyeballs, because Zillow and Trulia, if you put them together, they already have all the eyeballs. If they haven't made money yet from having all the eyeballs, they're not going to double their traffic. They can't.
No, and you know how much
so they have
money
to get more per visitor, and I just don't see how they can get.
I don't
they
either.
have to get 3x more in order to become profitable. Where's that going to come from?
And for them to switch their model, right? For them to switch a model is going to cost them way too much money.
And also expertise-wise, they'd have to change who they hire, who's there, their model of hiring salespeople to sell to agents, to sell them leads. They'd have to become a real estate brokerage.
Well, and if they do, then there's all sort of antitrust rules that will probably come into play there.
Then you're up against Then you're up against people who know what they're doing. You're up against Realty. You're up against Mr. Buffett. You're not just see what Trulia and Zillow have done very well, and you can't fault them for this. They've played the Wall Street game.
Oh, absolutely.
They've thrown out revenue, but if they were to switch to a brokerage model, the amount of time, effort, and money to slow their train down to do that, Wall Street would throw up all over, even if that was the right thing to do.
Right.
Their share, because their revenues would decrease, their expenses would increase, everything. The whole reason people buy it would be over. You'd be buying a new company. Now, eventually it might work, but that's just like with the U.S. economy. What probably would work in the long term would destroy the current economy.
Yep.
But no one's willing to destroy the phony economy to create a real one.
Oh, yeah.
So they just keep trying to push the phony one because it's been so profitable for them so far.
Well, and then here's the other thing. Okay, so if Zillow and Trulia did decide to become an online brokerage, right? Well, then you have RE/MAX, you have Keller Williams, who have already came out and said if they go that route, their listings will be pulled. They will opt out of the syndication, which would crush them if they did that, because then we're going to go to a model where basically all these real estate companies are going to have their own sort of MLSs internally, which is then going to make it harder to shop for homes, right? Because now you're going to have to go to all these different sites. So
and that's why they're not going to do it. So what they're going to do is they're going to stick to their model. From what I understand from the conference calls and listening to what they say, is that they want to basically get their agents to spend more and get more agents. And they throw out numbers like, there's X amount of billions spent, and we only have a small percentage of real estate agents so far. There's 1.8 million of them. But really, there's not 1.8 million of them that you can sell to, because most real estate agents are part-time, no time, just, the ones that are out there actually working and earning a living are probably 10 times smaller than that 1.8 million number. So the number of agents you can actually sell to is lower, and you can't sell to brokers. A lot of people don't realize that. Brokers, as a rule, because of the way you know this, and our listeners probably know this, but the investor probably doesn't know this who invests in these companies, the real estate broker does not have real estate agents as employees. They're independent contractors. Well, as such, they don't buy stuff for their agents. If their agents want to buy Zillow and Trulia, have at it. They don't care what they do, as long as they kick back their commission. What a broker does not want to do is buy a $1,000 package for each of their agents, give it to them, and hope it works out. No. Because now they've got the cost. What they want their agent to do is, if they want to spend $1,000 on Zillow and they can make money doing it, let them do it. If they can't, I don't care. It's not my loss. Right. So it's not like they can sell to the brokers. That means they have to sell to individual agents. They have to find, out of the 1.8 million agents, 2 million agents, whatever there are, they have to find the ones that are willing and able to spend. And that's expensive.
Yeah. Right. And, what's going to happen in the beginning is they'll probably start touting something where people, post your property on Zillow, post it on there versus putting it on the MLS. And what will happen in the beginning is people will try it only to see it fail, just as Dwayne Legate put his house on the market, hasn't had one inquiry. That's going to be more of the same. Then you also have the a la carte listing agreements that are happening all over, the 500 flat fee listing companies. How's that working out? And then Redfin, which has the rebate model, the do-it-yourself model, where they can't even gain a 2% market share in their own hometown, Lewis.
But and they're a broker.
And they're
back to your commissions Inc. guy. I don't know much about that company, but I would guess that guy owns the company, and he probably makes a net profit. Well, I know this for a fact. If he makes a net profit, he makes far in excess of the combined Trulia and Zillow. But yet Wall Street isn't diving over him to get a piece of his action, are they?
No, well, actually, they did approach him. They wanted to join up with him to potentially be able to get more leads, because the reason why
No. What I meant was I don't mean Zillow and Trulia. I meant
you mean
Wall Street is not interested in a profitable company, because he's not growing his revenues 40, 80, 90%.
No, and you know what? But
he's probably making money off of what he's doing.
Absolutely, and you know the only thing that he's actually interested in, because I'm a customer of his, and everything that he ever says always has to do with the revenue of the company and the revenue of the agents that are a part or buying his services.
He wants to make sure they're getting an ROI on what he's selling them.
Yeah, and go figure that model makes sense, right? That model makes sense. So,
but there's a limit to how much he can deliver. He can't sell to 600,000 agents. He doesn't have enough to do that.
Correct.
But Trulia and Zillow claim to go after that massive market share.
Well, you know, and interestingly enough, because obviously this has been tested over a period of time, but just as you have all those hundreds of thousands or millions of visitors on Zillow, so the sites that we have created that are internet leads where you run, there's Google ads that drive buyers and sellers to these websites, and then you're trying to get them to opt in so you can follow back up. So if we have 100 leads, Lewis, probably the best you're going to do, absolute best, probably, let's just say 5% of those. So let's just say there's a potential of 5 people out of 100. Mm-hmm. Okay? Now, that's very high. I would still say it's probably only 1 or 2. So the frustrating part on anything to do with the internet is that there's somebody that's kind of like behind the computer, right? You can't see them. Half the time, they put in fake information, fake names, fake emails, fake phone numbers. So when Zillow can claim that they have these millions and millions of people, that's great, guys. It's great that you can count the amount of people that are coming to your website, but most of them will remain mysterious. You'll never know who they are. You can advertise all you want on the right-hand side, but very few people are actually going to use them. They're not. It's just
you have to look at what we did is the top of the funnel to the bottom of the funnel. If you bring in 100,000 visitors, how many actually leave contact information? Of the ones that leave contact information, how much is valid? Is there a valid email? Is there a valid phone number? Of those, then it gets down to whether the real estate agent's any good, how many were able to contact, or has nothing to do with how good the real estate agent is. People just don't want to be contacted even though they left their information. And you get all the way down to, now, if you did contact them, how serious are they? If they are serious, did you get to work with them? And then if you did get to work with them, did you get it closed? So when you go from the top of the funnel to the bottom of the funnel, you lose 99% of the visitors.
Right. Yep.
Well, you know how much traffic you need then. There's not enough traffic out there with those percentages to get enough leads to sell to 600,000 agents.
Correct.
And there's not enough, and because there's not enough homes being sold to service that many. Because even if you were able to generate those leads, if the homes aren't being sold, why would they? It doesn't make sense. You can't have people interested in buying homes and those numbers, and they're not being those homes being sold. So it's not going to happen. You can't even get that many leads because that would indicate people are interested in buying homes, and there aren't that many people that are buying homes.
Yep. And you know,
no matter how well they increase their top of funnel to bottom of funnel conversions, because it's just not going to happen because there aren't that many people buying homes.
No, there's not. And, you know, and
even if it doubles. Even if it doubles.
But think about it, Lewis, too. A lot of the traffic for people going on to Zillow and Trulia and those sites are people that are kind of curious about their home value, right? That doesn't mean they're going to sell. That doesn't mean that they're going to buy. That doesn't mean anything other than they just want to know what the value of their home is. They could be 10 years out from doing anything.
No one is looking at the macro trends when they analyze these companies and saying how many homes are going to be sold and can these companies provide the bulk of the traffic to meet these buyers and sellers.
Yep.
Because even if they could, if you did the math, you said, okay, there's going to be X number of homes being sold, even if they got a good portion of that, it doesn't get you anywhere near where you need to be because there's not that many homes being sold.
Yeah, well, in an internet-dominated economy as we are in, it makes sense. The only thing that Wall Street ever cares about is just the traffic that people get. Who cares if you do anything with it, right? Hey, you've got
as long as it keeps increasing and you can show some improvement. But this is a revenue story, and as you know, in 99, 98, 2000, revenue stories were all the rage. If a company showed traction because they can increase their revenue, then they got a higher valuation until people realize, no, you see, what we really want out of a company is profit.
Right.
And, there comes a point. You can get away with revenue growth 2, 3, 4, 5 years in. 10 years? I don't know, Ryan. 10 years means you've been at it 10 years and you haven't shown it yet. What's going to be different? He keeps talking, the guy, the president of Zillow, keeps talking about early innings. It's early. No, it's not. The Internet's been around for 30 years. Online real estate's been around for over 10.
Honestly, Lewis, 10 years in, if you're the CEO, you're just kind of laughing because you're like, ha, I've made all this money. And
well, of course.
You know what I mean?
He's got to say that. He's not going to say, hey, we haven't done. Hey, he has done well. I mean, if you want to measure it by what they set out to do, which was create a dominant brand, they've done that.
Yep.
The second part is harder. Did they go public? They've achieved all of their goals, and they've exceeded their goals. So you give them credit for that. But Wall Street has never looked beyond what they're claiming they can do now.
Right. I mean, it's it's amazing to me just that the way the models for companies to be set up these days are just just get the traffic there, get your revenue. It doesn't matter whether you're turning a profit or not, because as long as you potentially do better the next quarter, even
look at Amazon.
Yeah, well, look at Overstock.com.
As long as customers if real estate agents are happy with Zillow, they're happy with what they're paying. If consumers are happy going there, and more people use Zillow, and more people use Amazon, and they don't make a profit, and no one seems to care about that, well, that's how you continue to operate. Amazon continues to lose money because Wall Street doesn't penalize it for losing money.
And you know what they did?
And we love Amazon. Give us cheap goods and send them to me shipping for free.
But you know what they did when Amazon, they were going through a lot of the earnings thing and they were questioning Amazon there for a little bit, you know what they did? They just took and raised up the Prime membership. So that's basically you can get deliveries in 2 days if you become a Prime member. They raised that up like $10 or $20 on the year, so they could say that they have to increase that because of the cost of doing business. They'll just make subtle little changes. It didn't make them profitable or any more profitable by doing that. And then they can talk. But
they reacted to the market, and then the market reacts positively to them.
And you know how else they can do things? They can just sit here and say, what our plans for the future are, and the technology that we're gonna have drones delivering things to people's front doorsteps.
You want a piece of that,
That's exactly. That's appealing.
But the difference between Trulia and Zillow, though, is and Amazon. Amazon does truly have a global opportunity to sell basically anything.
Yep, and
Zillow and Trulia are playing in a very narrow field, which isn't growing, as I can see it.
Well, and you have these commodities and easy things to sell on the internet, right? But versus real estate, it's a very difficult product.
Look, they can sell digital stuff with a click of a mouse. You can't do that with a home.
Absolutely not, and that's why what I think all this amounts to, Louis, is that Trulia and Zillow, this merger, Zulia, whatever you want to call it, it's gonna gain a little bit of traction in the beginning, but as we've seen for the last 10 years with Zillow, I think they're going to fail to actually be a profitable business. I think it's going to be.
That doesn't mean they won't do well with the stock price. That doesn't mean they won't get more customers. Doesn't mean they won't get more traffic. Even if they don't make any money, if Wall Street rewards them not to make money, they'll continue doing what they're doing, and they'll be a success.
And they can continue to be a bigger national brand that continues to build and build and build. But the CEO can go on TV, the economists can issue reports, people can listen to it like Case Shiller, they can become, a trusted name in news. Doesn't mean they'll make any money. It doesn't matter. In fact, they have so much money in cash, they don't have to make money for 10 years probably. Well, you got that right. And more people will gravitate there because there'll be more advertising, more sales and marketing that's pushing the site out there. So ultimately people will go there and they might try to sell their home only to fail and turn back to the professional, which is ultimately what's probably going to happen. I don't see really a way. They've tried to do this whole online brokerage thing, many different companies, and I think there's been some successful ones. And I think, but at the end of the day, people still like to deal with people. And
in real estate, you do. I don't want to see anybody who's selling me a CD or a book.
No,
but in real estate, I kind of have to.
Well, you do, because guess what? You kind of need somebody to go show you a house, right? I mean, it's kind of important. You can look at the pictures.
But Trulia doesn't say that they're trying to cut those people out, or Trulia, they don't say that. They'll say they introduce you to them.
Correct. But you know what? Most people don't.
But will they introduce you to the best one or the one who just pays to be there?
Well, and I don't know, Louis. Me personally, would you rather be introduced by an online website to somebody, or would you rather be introduced from somebody that you know, like, and trust that's giving you...
No like and trust unless the website is designed to... Like what we ran at Home Game was a Find a Realtor program, which was designed for you to meet 7 and compare them on an apples-to-apples basis and to interview them and then make a selection. Right. But that's not how they're setting up. This is pure advertising play. You pay and you're there.
Well, and that's why they're basically churning and burning. I mean, there's not many agents that will continue to market on these sites, and I know this because I talk to these agents. They're like,
there's the danger, Ryan, because once you run through the available ones who've churned, it's not like, churn on Google, people buying Google ads, they don't care what churn is because there's zillions of more people that will continue to buy ads on Google. Once you churn through a significant number of real estate agents, you've churned through a good portion of real estate agents. And there's no more being created that you can go and sell to.
True story. Last week while I was on vacation, I had 3 phone calls from different Zillow reps, all asking me to advertise.
How much did that cost Zillow to do that?
Yeah, well, amazingly, the first person called back twice. The second message was, hey, I don't want to bug you anymore. If you're not interested, I completely understand. But we just had this opening in your city. I was like, oh, that's a straight sales pitch, right? Because the way they set that up is that in the beginning, all these territories are locked down, and that you can only have so many agents in a certain area. But I tend to find it funny because I've talked to so many agents, and they've all told me the same thing. Have you had any luck with Zillow? Have you had any luck with Zillow? And most of them are all saying no. The reason why...
if it's not exclusive, Ryan, if it's not exclusive, the user goes and calls all 3 of them, or all 4 of them, how many they list on the page.
Well, yeah, and and then you know what? A lot of the time, they'll end up calling somebody off there just because they're trying to find out information about a house. You'll turn around and ask them a question. Hey, are you currently under contract with another real estate agent? And they'll be like, yeah, but I just wanted to call you to find out some information. Well, right. Then that person's going to say, well, how come you didn't call your agent? Well, because I see it right here on the internet, and I just figured I'd just take the time to call you.
Mm-hmm. Yeah.
So
and Zillow doesn't quite care about that as long as they can claim that they sent in their overall numbers X number of leads. They'll call that a lead, even though it's 100% useless to the real estate agent.
And that's exactly why in my area, Bristow and Gainesville, my primary target areas, I do local videos every day. I review listings of homes that come on the market in my area, which I've just basically localized everything down to give people the information they want to know about.
Yeah. And Ryan, you get 3845 visits. So what? Those are 3845 people that are really interested.
Yep. Yeah. And
you don't need to get 80,000 views on that video for you to actually meet the right. In fact, if you got 80,000 viewers, probably none of them would be interested because it wouldn't have anything to do with buying or selling a particular home.
But you know what? You just brought up a good point, though. You know what I should do, though, Louis? I should pretend like I'm Zillow, and I should go and I should just spend a ton of money getting as much traffic as possible to those sites. And then I can go around to all the businesses in Bristow and Gainesville, show them how much traffic I'm getting, get them to spend $1,000 to $2,000 a month with me, and I'll throw their banners up on my website. I'll make enough money to where it turns into a huge thing, and I'll go to every city around the country and have an agent do that just like I did. There you go.
And then you just have to make sure that you the amount of money that you lose isn't that great, so that you can always get more money, to borrow. And then you go to Wall Street and say, look, I grew my revenues, and my model is I can grow them even more. I just have to lose more money.
Yeah, I mean, hey,
and then they say, okay, let's go public next year.
Yeah, I mean, then once you get enough traffic, then you can just go to one of the bigger guys and then just have them buy you out, right?
Well, there you go. But that only happens. That only happens in a speculative economy because people are looking for growth stories because they cannot get money on a return with a dividend stock. They can't put money in a CD. There are no growth stocks. The only growth there is, if you think about it, in a real company, we said the way they're growing their stock price is not by growing revenues, it's by growing their earnings per share by buying back their shares. What's more exciting then is you buy a company like Zillow or Trulia who are actually growing revenues. And you think, wow, at some point they'll grow so much revenues that they'll make a profit, not understanding the underlying business model, how that might be hard to do. But at least it looks like if I'm going to be in the speculative game, and that's why all these social media companies have the highest stock prices, because unlike their counterparts who are boosting their share prices by buying back their shares and lack of revenue growth, these companies actually have revenue growth. It's not profitable, but they have revenue growth, so people buy them. And this is all part of a speculative economy created by the low-interest environment, created by the Fed, and this is what Janet Yellen and Ben Bernanke think drives an economy. So when the stock market prices crash, there's nothing there because these companies have no earnings, and the companies that do have earnings don't have an increase in sales. There's no underlying value being created other than share price value.
So how quick do these companies fold when this speculative economy turns on itself and starts to crash?
Companies like Trulia and Zillow don't fold because they have cash.
Correct.
And at some point, if everybody's doing it and it becomes the way to attract Wall Street is to say, here's how we're going to make money, they'll switch their model. And, they'll take the hit, but they've already taken the hit. They won't change their model. No one will change what's going on. Not the Fed, not speculative companies. No one will try to make sound economic decisions to make money and to provide for long-term profitable growth until they're forced to.
Right.
Because you'd be foolish. If I was a shareholder of Trulia and Zillow for the last 2 years, and they came out and said, we're going to switch the model because we realize we're not going to make money 5 years from now if we keep this up. Here's what we're going to do, and we're going to make a lot of money in 10 years, everyone would sell their shares, and you'd be furious with them because you're buying into the speculative story.
Absolutely. Yeah, and so,
So they're not going to change. They're going to keep at it. They're going to keep growing revenue, growing traffic. They'll blame the first year on not making money on the acquisition cost. There will be a reason why, just like with the Fed, every year, second half will accelerate. Second half will accelerate. There'll always be a reason why wait till next year.
Right.
And people are willing to believe it.
Yeah, well,
until
it'll be interesting to see how it plays out, and we'll follow what they're doing. If they do change their model, we'll follow all that and kind of see how it pans out. But at the end of the day, like I suggested, guys, obviously the best place to start a search, I don't care. You can look online, Zillow, Trulia, any of these sites. I mean, I always recommend any of my clients that I set them up on a specific search that's tied directly to the MLS that sends you a listing any time of day a new listing comes on. It's the best way to get the information. Now, you need to be working with the licensed real estate agent in order to get that. Now, is that the only way to search? Of course not. And do many people want to reach out to a real estate agent when they're just looking? No. So that's why you start your search on these sites like Zillow and Trulia and Realtor.com to see what's out there. But when you do start to get serious, I do recommend that you reach out to a professional because, once again, it's not as simple as just, looking at a house online, looking at the photos and understanding everything there is to know about real estate. It's just not that simple. And at the end of the day, people, when you are getting serious, you want to know the ins, the outs, and everything there is to know about real estate, the market itself, how everything has now changed to a buyer's market in most areas throughout the country. Knowing what you need to do in order to get your offer accepted, knowing what you need to do to get your house sold. I mean, these are all things that's not necessarily the Internet's not going to hinder you from doing, but you still need a professional that knows how to utilize the resources, which is the Internet, to get your home sold. You know what I mean? Unfortunately, there is a human component to this that most people tend to forget about. It's just because you put pictures and videos and all these other things on the Internet doesn't help your house sell. Okay? And once again, I can 100% attest to this because I buy and flip properties all the time, and it was just as easy as me throwing a house on Zillow, not paying any commissions. I'd do it all day long, right? But the reality is that's not going to take place. The reality is it's going to be another professional that brings a pre-approved, ready-to-go buyer to purchase a house that I'm, renovating and putting on the market as a turnkey home. Probably not going to get the phone call, hey, I'm looking at your home on Zillow. I'd like to meet you so you can show me this house. I don't get very many of those phone calls, Louis. I don't.
That does happen, and it's not like it never happens. There is a rate, and this is what's interesting. I haven't seen Trulia and Zillow publish there's a video back when you and I did the CBS radio show. I had done a debate with the COO of Trulia, and I was touting how, home getting a different model. What we had done was we tried to make sure that we knew how well our agents were doing, and with their permission, we would either give their name and explain how much money they made using the services that we provided, or in the aggregate, we would publish how well the agents were doing. I don't see that with Trulia and Zillow. They don't say that X number of our agents have an X number return on investment, X number percentage of agents are profitable with it. You don't see any of that. Now, part of that is because they don't know, But part of it is because they don't want to know.
No, they don't want to know.
And they don't issue their churn rate,
correct,
which is very, very important because it shows how well the agents actually believe the product works.
Yeah, I mean, you're
but there are
right,
successes, and during the video, the debate that we had was he gave an example, an example of a woman who said that these things work. And I said, okay, you could tell me Sally X says it works, but you have how many customers, for how many customers does it work, and how well does it work? Publish those numbers. Then you got a story.
Oh, yeah, I agree with you. Yeah, I mean, it's, there's a reason why those numbers aren't published. And once again, I think, as I mentioned, I think that Zillow, Trulia, they're good tools. But at the end of the day, it's for most people, it's going to make the most logical sense to work with a professional who knows how to utilize those tools to get you into a house or sell a house.
And you might find those professionals on Trulia and Zillow, but you might not, because they're not designed to help you find the best professional. They're designed to help you find a professional out of a few that happen to be advertising on the site.
Absolutely. Yeah, I agree with you. So, we'll follow this merger closely, Louis, just kind of see how it all plays out. We're coming up on the end of the show, Louis. I want to thank you again for coming on. If you would not mind giving our listeners, as you always do, your blog where they can check out your weekly blog posts, that'd be greatly appreciated.
Oh, thank you, Ryan. It's smallgold.com, SMAULGLD, and I put up a blog post every couple of days on the real estate market, the Fed, gold, silver markets. Currently, I have a few articles up there on the short positions in the gold and silver market, which are quite interesting because they amount to about half a year's production, Ryan, in the gold and silver short positions. So in other words, the bullion banks are short gold and silver in amounts that they conceivably could never deliver because it would require them to deliver half a year's worth of the production. So have those statistics on the site. Please go take a look.
Awesome. Thank you, Louis. I appreciate it. Guys,
Thanks, Ryan.
if you haven't already, please go to iTunes, download, subscribe, share the show, search Real Estate 360. You can also go to the website. We stream it directly from realestate360live.com. On the right-hand side, there's also an Ask a Question button. Ask any questions you may have, and we'll cover them on future episodes. Until next time, we'll talk.